Hey YouTube, this is Leo with DRIPCalc.com, and today I want to make a video comparing two of the most popular dividend ETFs in the dividend subreddit. So if you search for JEPI, basically this is what you get, and the number one result is SCHD versus JEPI. So that's exactly what we're going to do today. We will compare their total returns, dividends, as well as which one is a better buy for the future if you're a dividend-minded investor. So let's begin. But before we jump into it, guys, we finally broke 200 subs, so thank you very much to everybody who subscribed to the channel. So if you haven't subscribed yet, make sure to do that. Subscribe to the channel, smash that like button, and let's begin. Okay, so we're using our dividend compare tool, which you can find on the website right over here in the navigation. So anyway, these two ETFs, they're compared side by side, and it goes back to the beginning of the ETFs that has the shortest history. So for example, if we compared SCHD versus SPY, we would have a full 10-year history, but because JEPI is a more new ETF, it was created basically right after COVID began, so like in April of 2020, and so we have only 4.1 years of history, and that's where we compare. So we presume a $10,000 investment into both of these ETFs back in April of 2020, and back then the initial price of SCHD was $50.65, and the price of JEPI when it opened was around $50. So here it shows $49.94, and that's the close price on the first day of trading. So basically it was $50. And so you would start exactly with almost the same number of shares if you invested 10 grand into each of these ETFs. And so far, with dividends reinvested, your total return on SCHD would be 82%, and the total return on JEPI would be 63.5%. Okay, so you can compare this yourself. Just go to our website. I won't go through every line, and but basically here it shows you total dividends collected, dividends per period, because SCHD pays quarterly and JEPI pays monthly. So anyway, let's look at this graph, and here we have a total return with dividends reinvested for each one of these funds or ETFs, and basically you can see that throughout this 4 years SCHD was pretty much always ahead of JEPI, except for like right over here it was down a little bit compared to JEPI, but for the rest of this period it was always ahead. And so while total returns in the past or past returns do not guarantee future performance, if we look at dividend growth curve and dividend chart, you can see here that SCHD is growing their dividends at almost 12% per year, and that's compounded, and this is for the last 10 years. Okay, so this is a pretty good history, and we can see over here it's pretty much going up and up and up, and increasing every year. And yes, you have some dips over here, and that's basically because they do reconstitution in the first quarter of each year. And so the first quarter dividend is always the lowest of that year. Okay, but then they kind of fluctuate because it depends on when their underlying stocks have paid them dividends for them to distribute. Okay, so JEPI is slightly different. JEPI holds some shares in some stocks. To be exact, it's about 86 stocks. If we look over here, so if we look over here at our ETFs page, so they have 114 companies. All right, so stocks in 114 companies, and what they do, they also sell cover calls on part of their position. They also use some other mechanisms, and we can basically scroll down over here and figure out how JEPI makes money. So the fund seeks to provide majority of the returns associated with its primary benchmark, S&P 500 Total Returns Index, so S&P 500 index, while exposing investors to less risk through lower volatility, still offering incremental income. Okay, so they have a pretty high dividend yield, but very small growth. Okay, so if we compare that to SPY, because they say they track S&P 500, you can see like SPY went up 101% in the same period that JEPI went up 63%. Okay, and actually, wow, SPY over here in October 2022 was actually returning the same exact amount or percentage as JEPI. But then it took off, and over here now it's like 40% higher total return than JEPI. So back to JEPI versus SCHD. Now let's take a look at this table again, and you can see that JEPI has paid a lot more dividends than SCHD during the same time, but the price appreciation on SCHD is much better. and that's where you see the total return. So in a nutshell, the total return of SCHD is higher because it's increasing its dividends, whereas you can see over here JEPI is actually, the dividends are going down and down and down. And this is what I want to talk about. Basically, JEPI is a fund that does better, like they have lower volatility, and they do better during a down market. Okay, so what they do is they sell covered calls on some of their positions, and what happens in the up market, when everything is going up, they are called out. They are assigned their shares that they sold covered calls on, and so they have to buy those shares back at a higher price. And it is in a way similar to QYLD, but QYLD sells covered calls on their entire portfolio, and that's why they have negative returns, whereas JEPI sells covered calls on part of their portfolio, I believe up to 20%, and they do some other mechanisms. But overall, you can see that they did the best over here in 2022, when the market was down. The S&P 500 was like 3,500, and now it's 5,600, give or take. So way up. But they did the best over here. But as soon as the market started rising, so over here in January 23, that's when the ChatGPT thing broke out and Nvidia took off. And basically ever since then, their dividends are going down and down and down. And if you look at over here, so their last dividend in July of 24 was significantly lower than their first dividend in July of 2020, so 4 years ago. And even the August dividend of that same year was about the same as it was a month ago. Okay, so basically when the market is going up, the dividends of JEPI go down because they do not make as much money as they would in a down market or in a flat market. Okay, at the same time, SCHD is working on a completely different mechanics. They basically pile in a bunch of dividend-paying stocks, and they collect the dividends from those companies and distribute them to the shareholders. And that's why you see the way they pick out stocks. There's a whole methodology to this. I'm not going to dive into it, but they use an S&P 100 dividend payers index, I believe. So don't quote me on that, but that's their base, and then they apply different criteria to include or exclude companies from their holdings. But as you can see, the dividend payments go up all the time, well, most of the time. And what's also interesting is the dividend curve or dividend yield. So you can see here they started at 2.62%, that was 10 years ago, and throughout all this time the dividend is actually increasing, the dividend yield is increasing, so they're up by a whole percentage point since then. So wow, that's amazing, guys. And you can see over here the dividend CAGR, 11.85% annual dividend growth. So that's compounded, and that's why you see the dividend increase is so high. So they have increased their dividends by a lot. And so now the question is, which one of these ETFs is a better investment? So on one hand, you're collecting more money with JEPI every month, and let's assume they keep paying around 33 to 36 cents. Basically, in every quarter or every 3 months, you're collecting about $1. Whereas SCHD, they just paid their highest dividend ever. This is like, they never paid a higher dividend than this. And I assume next month will be lower. It would probably be around 75 cents, knowing the history. And also, if we look over here at our ETF dividend estimator, so yeah, they would, our system estimates they will pay 76.8 cents, but you kind of have to spread that out throughout the year. So they could pay a little less, could pay a little more, and it also depends on the number of outstanding shares on the day of declaration. So, but on average, they will pay about 75 cents this year until they do reconstitution next year in the first quarter, next March. So on one hand, you collect more dividends with JEPI, and you can see forward yield with JEPI. Even now, it's still 7%, whereas forward yield with SCHD is 4.14%. And actually, it's lower because this is based on the latest dividend payment, which I assume will decrease. So you're just under 4% forward yield, and that's based on today's price, which is just around $80. So you collect more dividends with JEPI, but you have better price appreciation with the SCHD. You can see over here, 10-year price CAGR, 7.5%, but even like a 2-year price CAGR. Let's compare that, because JEPI did not exist 10 years ago. So 1.5% average compound price increase for JEPI over the last 2 years, and for SCHD it's 5.5%. Another thing, very interesting, guys, you're kind of still getting a discount on SCHD, especially compared to S&P 500 and NASDAQ, because basically it was 3 years ago over here, July, where are we in July? So somewhere over here, mid-July. So we were sitting at $76, and today we're sitting at 80. So it's a very small increase, just $4. That's less than 5% over 3 years increase, whereas S&P 500 is up by like 20% since then. So, and the dividend has increased tremendously. Like, so 3 years ago, that was July of 21. Where are we? So it's 54 cents, give or take, and now it's 82 cents. So huge increase in dividends, and price remained the same. That means you're getting a lot more dividend for the same price. So it's a great relatively great buying point for SCHD. Now a lot has changed since then. They've removed some companies from their portfolio, they've added some companies. Most notable, they removed 3M, which is a terrible company. And they've also removed Broadcom stock, and the reason for that is because Broadcom stock price went up through the roof, and their dividend yield has decreased dramatically, so it was no longer fitting the criteria for a SCHD portfolio, so they removed that. That was during March reconstitution of this year. They've made some other changes. I actually made a video about top 10 SCHD holdings, and that's available on our channel. But if you go to the SCHD ETF page, basically here are the holdings, and the number one holding right now is Home Depot. Wow, the price really went up on Home Depot. Back then it was like $330. But anyway, that's neither here nor there. It is for another video. So anyway, what I want to talk about is which one of these dividend ETFs is a better buy for investors. And for that, let's take a look at the bottom of this tool, the stock ETF compare tool. And these are our projections of the total returns of both of these funds. So as you can see over here, this is based on a 4-year history of each of these funds. And so during that period, the share price CAGR, or annual growth of a SCHD, was 11.41%, and their 10-year dividend CAGR is 11.85%. Okay, and now if we look at JEPI, since inception, their annual growth of their share price is 2.68%, which is abysmal, and their dividends are actually going down cumulatively every year by about 4%. Now, if we have a big recession, the dividends should probably increase, but the share price will go down. So that's actually, in JEPI's case, that's a good thing, because you might go back to the 10% dividend that it was paying, like over here, 12% back a year ago. But now it's paying just, forward yield calculated at 7%. But anyway, so if we go based on these numbers, and you invest $10,000 into each one of these ETFs, and these are linear projections, they don't account for any recessions. So basically, at these growth rates, you're expected to have about $40,000 in a SCHD in 10 years, and that's given the current share price and dividend growth. And with JEPI, a measly $15,000 final value, so you would only earn about 50% on top of your initial $10,000 investment. And don't forget, guys, you would actually be paying taxes on those dividends. Now, again, it is projecting a decreasing dividend over time, but if we have a recession, the dividend will go up most likely. Now, it's not a guarantee, but that's what happened to JEPI during the drop in the stock market 2 years ago. Okay, you can see over here, this is the bottom of the market, basically like right over here, October, November, December, and after that the market started going higher. It just like took off like a rocket ship, and the dividends for JEPI went down, so did the yield. SCHD does not follow the same formula, so everything is rising for them, except for the share price, which has been flat for the last 5 years. Now, it did crash over here during COVID, and JEPI was basically was just released somewhere over here in May, so they were almost the same price. Anyway, so going forward, I don't think, and now again, this is not an investment advice, but I think out of these two ETFs, SCHD is a much better ETF to invest in versus JEPI, because there's just no growth with JEPI and diminishing dividends, or dividends going down. But since this is a linear projection, let's actually use our JEPI dividend calculator. So everything is plugged in here. Actually, it shows dividend decrease minus 10%. So let's call it, let's pretend it's flat. Let's say it stays flat and the share price actually goes up, and you invest. Now this is monthly. Yep, everything is correct. We don't add anything to the investment. Let's go 10 years. Okay, and assuming the dividends do not increase, you're expected to end up with $23,464. That's for JEPI. And for a SCHD, let's go over here. So SCHD, what I actually want to do is reduce the dividend CAGR. Let's call it 1185 because that's the last 10 years. And share price will leave alone. An actual dividend amount, I don't want to use their highest ever dividend because that's kind of not fair. So let's call it 76 cents because that's what we estimate will happen. That's our calculation for the dividend. Okay, so again, 10 years. We do not invest any additional capital. And by the way, guys, this price is near 52-week high for a SCHD. Now if I look over here, so the highest price they had this year was $80.82, and that's 52-week high. It didn't close. I'm not sure if it's a closing price. Maybe it's a close price. It actually went up to like 81 something, but the closing price was 82. So we're about 82 cents away, or about 1% away from 52-week high. And for JEPI it's not. So let's calculate this. Same settings, and you're expected to end up with $30,000 in 10 years. And that is a much closer to reality, because if we look at 10-year return for SCHD, you can see 183%. 10-year return, that's with dividends reinvested, guys. And also here, this is with dividends reinvested. So if we show no DRIP, no dividends reinvested, you will end up with almost $26,000. But the 10-year is not a good timeline. It really begins to shine over a longer period. So look at that. Without putting in any additional money, over 20 years, you're expected to 12x your money. And by year 11, you will have collected more dividends than your initial investment. Okay, and after that, it is a hockey stick up. If we look at 30 years, this is it's completely insane. By just putting in 10 grand right now, you're expected to have a 68 times return, so 6,080% total return, and your total value will be like $690,000. And if you, let's say you just put in $100 a month into this ETF, you'll have pretty much double that at almost $1.4 million, with the total investment being $46,000. That's the total money you actually put in throughout these 30 years. Okay, and with JEPI, let's do the same for JEPI. Where is it? Okay, right here. So let's go 30 years and $100 monthly additional invested, $214,000 versus 1.38 million. So guys, yeah, you get a higher dividend up front, but you basically get no growth, especially when the stock market is going up. Throughout history, SCHD just did way better than JEPI, even though JEPI paid a much higher dividend. But also, what's funny, let's take a look at taxes situation with JEPI. So I made a quick tax calculation table, but let's take a look again at the total return. So it's 82% versus 63.5. So let's switch to our table. Okay, so here are the total dividends for each of these ETFs. 2,200, 28 and 4,879. Okay, so now what's interesting is, and this is very important, SCHD is qualified dividends, so they're taxed at your normal capital gains tax rate, and we'll jump into that. But JEPI is non-qualified dividends, so they're taxed at regular income, or so anyway, ordinary income. That's the tax rate for JEPI dividends. So if we go to IRS website right here, so let's say you're making 100 grand a year. Okay, so you're in a 24% tax bracket. And if that's the case, then you are paying a 24% dividend on JEPI. Okay, and so because IRS is like their website is a bunch of legal mumbo jumbo, let's take a look at this smart asset website. So here they have qualified dividends tax rates, and so if you're earning 100 grand, you're over here, and you're single. It actually doesn't matter, single or not single. If you're on 100 grand, you fall into a 15% qualified dividend tax rate bracket, and if you earn under 47, you basically don't pay any dividend taxes. But we're sticking with the 100,000, whether family or not, doesn't matter. So actually this is single. Where is the? I want to see the family, but anyway, so we'll assume single, and let's go back to this table. So you would pay $334 in taxes on your JEPI income at 15% rate, and $1,171 at 24% tax rate on the JEPI income. So your net after taxes is $1,894 for SCHD and $3,708, and that's in dollars, for JEPI. Okay, and so end values, again, we take them from here. So 18,214 and 16,349, and we subtract the taxes from that. So we get 17,880 and 15,170. And so now the total return percentage for SCHD, let's make this even smaller so we can actually like compare it side by side right here. So for SCHD it's almost 79% total return versus 82, so you lose like 3% of your total return. However, in JEPI's case, it's 63.5, and that goes down to 51.78. So call it, yeah. So basically that's almost 12% reduction in total return, and that's just because of taxes. Now, if you have, you know, an IRA or something like that, like a tax sheltered account, that's not a problem for you. But a lot of people, they so for example, if you're retired and you want just dividend income, you will be paying likely taxes on it depending on your total income. But because SCHD is qualified dividends, you pay a much lower tax rate than JEPI, where you pay ordinary income tax rate. Now, you don't pay social security on this stuff, so that's good. And on top of that, you also pay state taxes, but that's irrelevant because you usually pay the same. Well, I can't say that because there's like 50 states. I don't know the tax situation in every state, but for example, in Massachusetts, you're paying 5% no matter what, whether it's dividends or ordinary income. So anyway, yeah, bottom line, you get a higher dividend with JEPI, and no, there's no guarantee it will stay that high. It might actually keep going down, whereas dividend for SCHD is going up. You can actually see here, well, this is after 4 years, basically. You're collecting 188 per quarter with the SCHD. I don't know how that's calculated. They probably took. Yeah, this is it doesn't matter. Yeah, so here you're collecting 82 cents per quarter versus like $1, and that's based on the latest payments. But you know, a couple years from now, that will go up. But your growth in dividends with the SCHD is far superior, and over 10 years. Your yield on cost will probably be much higher with the SCHD. Actually, it's easy to see. Let's go over here. So let's look at 10-year mark. Yield on cost 10.13%, and with SCHD we estimate the yield on cost after 10 years 12.5%. So you'll actually be getting a higher yield on cost with the SCHD versus JEPI. And so yeah, that's basically my overview of these two funds. And guys, honestly, like, JEPI, you know, there's a huge following for JEPI, and I actually posted on Reddit. Let me go back to that post. So here's my post where I say that I sold 45 shares of JEPI and bought Tesla with the proceeds. And so I was actually up on the JEPI, and in the hindsight, I am actually down on those Tesla shares, even with the high dividends that I have collected. But that's a whole different discussion. And actually, when this hits 1 year, I actually want to come back to it and compare exactly where, you know, from my sale to my purchase, how many shares I bought and what's the total return during that year will be. Now, right now, I don't have an option to basically do this for 6 months, it's in full years, or either I need to like modify my system, which will take a long time. But so in 6 months I want to make a video and compare, exactly what happened. The 45 shares of JEPI that I held, how would that perform over a full year versus the shares of Tesla that I bought back then. But the funny thing is, like, all the comments, Tesla has been a disaster. Well, that's true in a way. Anyway, I like this one. Tesla is great if you like movement, but you probably won't like the direction. So this is in JEPI subreddit, and basically everybody is telling me I'm an idiot for selling JEPI, but I still disagree, and in 6 months we'll have the answer. So Tesla has been doing pretty terrible for the 1 year. Again, we can't do 6 months, but let's compare Tesla to JEPI over 1 year. And JEPI is up 11% now. That's with dividends reinvested, and Tesla is down 18.5%. But the good part is coming back up. Now the thing is, like, that was in December, I believe. Yeah, it doesn't tell you when exactly, but I believe it was January maybe. And unfortunately, yeah, where are we? Oh, right here. Fortunately, we have to track it basically from here. And yeah, basically, when did they have the split? Right here. So this was about right here in December. It went down, came back up a little bit. Maybe I'm flat, probably I'm down, while JEPI actually went up. And again, this is total returns with dividends reinvested. But in a year, in 6 months, we'll see. In 6 months, we'll see. But overall, guys, this is not the only yield max ETF that has tremendous returns. And you can see, like, these 3 ETFs right here, NVIDIA, Connie, and Misty. And this is past 12 months returns. Like, total return for NVIDIA is 97% versus 11% for JEPI. Connie total return 90%, Misty 83%. And that's considering that both Connie and Misty have dropped significantly in their share price in the last couple weeks. But anyway, that's a whole different discussion. But yeah, Tesla is wow, it gave up number 2 position for the worst performer to another Tesla fund, and this is inverse Tesla, or like short Tesla, because they had a massive run up in the last few days. So Crash, which is a short Tesla, you can see right here. Where is Crash? Right here. So they have a huge loss in just a couple months. But overall, Tesla was number 1 for the longest time, and it moved to a 2nd position from the bottom. But I'm actually I broke even on my Tesla position, and from going forward, and that includes the share price, of course. But they're paying amazing dividends, unlike JEPI. So I think I still prefer Tesla to JEPI. And if I was to buy right now, I would still buy Tesla. Anyway, so another thing unrelated to SCHD and JEPI, I will be making a video. I already made one right here. So July estimates. So, but that was like a week ago, and things change rapidly with YMAX and YMAG because they get people buying into the fund. So I will make another video with dividend predictions based on the most recent number of outstanding shares. So I'll make that on Sunday, hopefully, and then we can have a more accurate estimate. So make sure to subscribe to watch that video, come back. So if you're choosing between SCHD and JEPI, I think for long-term returns, SCHD is much better, given the past data. Now, past returns are not guarantee of future returns. However, we have a clear, tendencies for both of these ETFs, and we can clearly see that JEPI performs best in terms of dividends during a down market, and SCHD is just going up in terms of dividends, whereas their share price has actually barely moved. Like, it moved down, but it didn't move up. So I actually bought over here in October for about $69, so I'm up on that position. I've been trading in and out, but this was not right now. I'm just holding for dear life and not selling those shares and collecting dividends along the way, which keep going up and up and up, and that's a good trend. You can see once again the dividend yield curve right here. It is positive for SCHD, even like over here it normalized because it now had a full year of data. So it was 285 in 2012, end of 2012, and now it's 3.66, and this is trailing 12 months yield. This is not forward yield, this is a regular yield. So still an upward curve, which is good, guys. So yeah, if I was to invest long term, definitely SCHD. And for short term or for income right now, again, JEPI is not offering great returns right now, less than 7%, plus you got to pay 24% tax on that. So that basically turns into 5.25, 5.5, give or take. And that's not a very good return because basically you can actually get the same return in a, well, not the same, because if you put it in high yield savings account, you also got to pay taxes on that. Anyway, I don't think it's a great return for JEPI, and there are yield max funds that offer a much higher ongoing income. And I will make actually a video about that next, so stay tuned. Again, guys, smash that like button, subscribe to the channel. I know this was long, but I hope you watched to the end. And yeah, that's it. I'll see you in the next video. Bye.